Good evening, everyone. I welcome you all to the Alternate Universe webinar series, episode 9. And today's topic of discussion is discovering opportunity in the current equity market scenario. Myself, Bhavadharani, research analyst at PMS Bazaar. We have an interesting guest with us today, a well-known figure in the industry, Mr. Ashish Shanker, Managing Director and Chief Executive Officer at Motilal Oswal Private Wealth. Is an alumnus of Harvard Business School and a business management graduate from the University of Bangalore. He began his capital market career as a research executive for a leading brokerage firm. Subsequently, he worked in the asset management industry for over 6 years. And for the last 14 years, he has been in private wealth management across organizations such as Standard Chartered, Bank Saracen in sales, investment advisory, research, and product roles. He has won several accolades during his stint at these organizations. He's the architect of investment platform at Motilal Oswal Private Wealth and is responsible for creating their highly acclaimed 4C framework for selecting fund managers as well as Delphi platform solutions. He's a regular invitee on leading business channels and authored several articles in leading economic dailies. Now, moving on to another lively personality, Mr. Vikaas Sachdeva. He's an industry stalwart with over 3 decades of experience in the asset management business. He's currently the managing director, Sundaram Alternates, driving growth across different platforms, geographies, and asset classes. Lastly, we have Mr. Karthik Athreya, Director and Head Strategy, Alternate Credit, Sundaram Alternates. He's a financial service professional with over 2 decades of experience across financial services industry. He's currently leading a team which manages assets over 250 million across real estate and private credit. Over to you, Vikaas.
Thank you, Bhavadharini. I hope I pronounced your name right.
Yes.
A very warm welcome to Ashish and Karthik. And as is the pleasure which I have, I'm introducing Ashish Shanker, the person behind the profession. So, Ashish, I must tell you that I spoke to quite a few of your colleagues, been doing what is commonly known as investigative journalism. The only thing is it's into you, your characteristics, your traits. And I must tell you that your colleagues, your friends, they speak very, very highly about you. In fact, your colleagues talk to you about as a person whom they find very easy to work with. You're quite pleasant. You're a team person. In fact, one of your colleagues said that you do not believe in bossgiri. That was interesting for me. You're a very voracious reader and implement what influences you. You particularly appreciate books on finance, economics, and business. And not just that, you ask people across various functions to read. One of the authors, Michael Mauboussin, he's a prolific financial literature. I mean, he's an author in the financial literature journal, and he's been quite an influence on you. I think he's also responsible for influencing you in terms of the Alpha Strategist, one of the premier publications which you personally have handled. In fact, that actually shows what you truly are as a person. And I must tell you that you have quite a few people who enjoy reading it, including yours truly. I've always waited for the issue to come out, and I heavily recommend it to everybody who comes in touch with me. You are quite competitive when it comes to business. I would have never guessed that. You're usually quite composed and intense, but I've been told you're quite competitive when it comes to business opportunities. And when it comes to large clients, you lead from the front and you take charge. You're quite a perfectionist at work and are fairly accommodative of people's opinions. But you do insist that whenever work does come to you, a lot of diligence has been done, and you're quite, unhappy when you find shabbiness in work which is brought to you. Yeah. So these are some of the very interesting things, and I'll detail a little bit more. Uh, your colleagues are actually intimidated by the fact that you can spot an error in an Excel sheet from a mile away. I mean, you are quite a numbers guy, but for somebody to do that, so they're extremely wary when they bring you data. At a personal level, your colleagues find your dress sense very formal and very conventional all 5 days of the week. In fact, some of them actually tell me that before a festival or an occasion, they have to actually remind you that tomorrow is the festival. The previous day they tell you so that you come dressed up in accordance with the festival. Uh, your wife Shikha works as an IT consultant with one of the big four firms. Your son Ishan, all of 15, is an extremely talented football player, and he's played for Bangalore FC, right? And such is the love that both you and your son have for football that you actually went to watch football at the FIFA World Cup all the way. One interesting piece of information which I got, which was quite surprising, is you're quite the sports person yourself. I mean, you do play football, badminton, table tennis, but you've been a nationally ranked table tennis player and ranked number one between 1989 and 94. Is that
Yeah,
information correct?
that's right.
That's
Sub juniors
that's
and juniors.
that's quite amazing. I mean, I would have never guessed. You love Western classical music, and you've actually trained to be a pianist back in the day. This is something I think most people in the industry won't know. This was amazing information. Well, your colleagues also do talk about the fact that you're quite the foodie, okay, and you enjoy trying out new restaurants and new cuisine, particularly in the non-vegetarian variety. Also, uh, after 6 o'clock, and especially at a party, your colleagues talk about you as being the joie de vivre, the joy of the party with your sparkling sense of humor and deliciously worded anecdotes. You keep quoting the best advice you've ever received from a boss, which I think would be quite interesting to the audience as well. That equanimity is the best possible way of dealing with situations. Maintain your sense of humor despite ups and downs. Don't take yourself seriously. So thank you so much, Ashish, for gracing the show. I look forward to the next 45 minutes or so having a tete-a-tete in terms of a lot of different topics, including equity markets. Welcome to the show.
Yeah, thanks, Vikas. And also thanks to Bhavdarini for that kind introduction. And thank you very much for your kind words, Vikas. I mean, hearing it from someone else about yourself almost, feels like a different person the way you're narrating it. But, clearly you've done your research and you've spoken to a lot of people. And some of the things you've dug out are things probably which a lot of people don't know about me. So thanks for that. Thanks for doing that. And really a pleasure to always speak to you.
On a lighter note, if I knew I was so good in research, I would have probably come to Motilal Oswal a long, long time ago.
You're always welcome.
But okay. So let's while we were talking to the audience, or rather when we were soliciting questions, needless to say, the most asked question currently is, with the markets at an all-time high currently, or near an all-time high currently, what's in store for the Indian stock markets? I think the correction over the last few days has unnerved a few people. So the question which is coming in is, are we in for a pause or a correction? How do you assess the relative growth prospects and market valuations of Indian equities versus global equities?
Yeah, so very interesting question, Vikas, and I think this is something that is at the top of everybody's minds, whether it's advisors, clients, and individual investors. See, I mean, as Howard Marks quoted, that you may not necessarily know what is going to happen, but you should definitely know which phase of the market you're in, right? He talks a lot about cycles. So I believe a lot in it. So if you look at the current cycle, right, we had very clearly said in our Alpha Strategist also that we are in a very sweet phase as far as the Indian economy is concerned. We are in a sweet phase as far as Indian markets are also concerned. I mean, and just to contextualize it, the last decade was not that great for Indian stock markets. If you look at the total Nifty returns, it was very, very suboptimal. In fact, US did extremely well. And we all know the kind of changes that have happened in the economy and what is driving this phase of growth, the quality of the growth, so on and so forth. So we can delve deeper into it during our conversation later. But to address your question, we strongly believe that this is a very strong phase of equity markets for India. And this is driven by very strong economic fundamentals and corporate profitability, right? So it's not just, a rally based on intuition or hope. And at every stage, when the market rallies, you have earnings catch up, or sometimes you have the earnings going ahead and then the price is catching up. Just to give you a little example to make it simpler, I mean, in September 21, you were at about 18,000 Nifty, right? And today you are closer to 20,000. In 2 years, markets have actually not gone anywhere. I mean, they've gone up. In Nifty, they've gone up like 7-8% or 5-6%. But in the same period, earnings have gone up about 30%. So today, markets are actually 25% cheaper than where they were 2 years back, right? Earnings in the last 4 years have almost doubled, right? And the earnings visibility over the next 3 to 5 years is looking extremely solid, right? So you're in a phase of a bull market. So in bull market, often I keep saying that, don't try and predict what's going to happen tomorrow. I mean, you may see a 10% correction, or you may see a 5 to 10% uptick, but it's more important to get the direction right. So we are clearly in a bull market, and I think there is a lot of steam left ahead of us in the next 3 to 5 years. So according to me, the longer term investors actually should view every correction as a buying opportunity. I mean, just to paraphrase and go back to 2003 to 8, because that's the most recent bull market that everybody has seen, right? You had many corrections of 10%. In fact, you also had one big correction of close to 30% in 2006, and maybe a minor blip in 2004 after the elections. But the market went from 3,000 to 21,000 on the Sensex at the peak. So we believe that this phase of markets is rhyming with that phase, and clearly, for a longer term investor, every opportunity, every correction should be seen as a buying opportunity. Near term, one may argue that some of the medium-sized, smaller kind of companies have run up very, very rapidly, especially in the last few months. And there are multiple challenges on the global front. So maybe in the near term, as you run up to the elections, markets could be a little more volatile. So you may want to stagger the entry of your investments, but that's more, how do you invest, right? There is no doubt in my mind that you should be full up on your equity allocations and be positioned for the next few years. So that's how I see markets where they are today.
Superb. I think that's as confident or as clear an answer as one could expect in this sort of market. Thank you for that. You talked about opportunities. One of the other questions which has come across is, what are the 3 trends that you see over the next 3 years? So I'm just taking maybe a mid-term perspective, neither too short nor too long, a 3-year perspective. So are there any trends which you see emerging which investors can capitalize on at this point of time?
Yeah, clearly, Vikaas. In fact, again, this is something that we have spoken often in the last couple of years. We strongly believe that a lot of the investment related themes will do extremely well, right? If you look at the previous decade, the investment to GDP ratio was on the lower side, right? We didn't see a lot of gross block formation, especially in the private sector. With bank balance sheets, extremely clean right now, corporate balance sheets delevered, and demand visibility looking much better over the next 3 years for multiple industries, I do believe that we need to invest in infrastructure and capacities at scale with speed. Right now, one part of that equation will be solved by the government, which is public infrastructure, right? And we can continuously see that the government is doing a lot in roads, defense, the asset side of the infrastructure, which is ports, metros, so on and so forth. So that part of the infrastructure building is already picked up steam. Now, as far as private capex is concerned, I mean, both you and I know that private capex typically follows demand growth and demand visibility, right? We can already see green shoots in that space. I mean, whether it is in contract manufacturing, you see a lot of companies trying to scale up, whether it is in some sectors like steel or even chemicals, and there are multiple themes playing out here. One is the domestic demand theme emanating from government spends. Then there is the demand emanating from private capex gradually picking up. And also, there is this China plus one, or, India slowly getting better in manufacturing as a theme. Now, all these are gradually contributing to the investment side of the GDP. And a lot of these companies have been neglected. A lot of the sectors have got consolidated. So you have stronger companies. And one big theme is real estate, because for households, capex is essentially buying a house. Right. So real estate is picked up in a very big way. I mean, quarter on quarter, you're seeing all developers hitting all-time high sales. So I see that private capex, government capex, corporate capex, when I say private household capex, these 3 themes will lay the foundation for growth in this cycle. And a lot of the companies which are in these themes will definitely do very well. The other theme, Vikas, which I think we have all been bullish on, and I think certain categories will definitely pick up steam, and you will see I'm using a very strong word which I've used in many forums, that you will see a demand storm in many categories. Because as you move from $2,500 per capita to $4,000, right, the kind of demand you'll see in discretionary categories will be exponential. Now, underlying, because see, a lot of times you get lost in the averages, right? $4,000 per capita is still not a very, very high per capita from a global context. But you just delve deeper, the number of households which are about $10,000 per capita, and $10,000 decent income, it'll be between 8 lakhs to 10 lakhs, depending on where the rupee is, right? The number of households in this category are almost doubling. It's going from, if I'm not mistaken, 7 crores to 16 crore households, right? So a lot of categories, whether it's apparels, auto, housing we spoke about, travel, right? People are going to want better quality of life. People are going to want to improve, what kind of consumption they do. So a lot of categories will see demand. So I think broadly, these are the themes we are bullish on. The good part is that you have a wider selection today because growth is more broad-based, right? So you have a buffet, and then finally we know equity is micro. Finally boils down to either you give the money to a fund manager who can pick out the entrepreneurs who are going to capitalize, or you have to spend your time doing research on companies which you think are best positioned to execute this opportunity, right? Ultimately, investing is all about micro, but you can take a view from a macro point of view. So these are broadly the themes that we are extremely bullish on, and we have spoken about it on multiple forums.
I like the word demand storm, which you mentioned, and I think the demand storm will probably lead to a melt up in the markets, right? So let's hope that this comes true. You also mentioned about real estate, and while you talked about real estate, I could see Karthik's eyes twinkle, in a way, because Karthik heads private credit, and real estate debt is one of the products which he also looks at. So Karthik, I'm sure you would want to ask a few questions. Over to you.
Yeah, no, all extremely valid points that Ashish has made. In fact, my eyes lit up on the relative performance that Ashish pointed out between India and global markets, and clearly, even including our conversations, have pointed to the fact that India is experiencing a very, very strong structural bull run. No question about it. But I was curious, Ashish, whether it is building local equity portfolios, or offshore. The very constant discussion that we get and the debate that we have, which has often, the last 20 years been a difficult debate, has been the currency on the rupee versus the dollar, and emerging market risk plus currency volatility risk and so on. So while forward premiums have reduced quite substantially, reflecting the strength of all the points that you just mentioned, how do you view people looking at building dollar equity portfolios or dollar portfolios in general, versus rupee portfolios? And this is obviously specific, to investors in India. So I was just curious on your thoughts on where you think the debate on the INR versus the USD is going.
Yeah, so very, very interesting question, Karthik. I do believe that integration with the globe is happening at a very fast pace. Most of the rich Indians, when I say rich, I'm talking about HNI, is typically someone who has a net worth of maybe close to $500,000 upwards, right? All of them aspirationally want to do a foreign holiday or send their kids overseas. Today content is delivered digitally, so you're watching content from across the world. So there is aspiration to become a global citizen, right? How does that translate to thinking about investing? Now, I still feel that this is going to be a strong decade for India. So clearly, there is a home country bias in investor portfolio. So clearly, a large part of your portfolio will be Indian assets, whether it's fixed income or equities. But a lot of HNI families are seriously thinking about building a global portfolio. See, a lot of the larger family offices already have some funds overseas and they have a global portfolio, but a lot of HNIs have started seriously thinking. You've seen the advent or maturity of the feeder funds in India. I mean, as a firm, we run a very large index portfolio, as you know, which feeds into global indices. And one of our index funds is the largest, the Nasdaq. So already a lot of HNIs are allocating money in dollar assets through feeders. But I think it is going to become even more interesting as a space, as the kids go overseas, or you start traveling overseas and you want to have dollar assets as a diversification in the portfolio. Now look, my advice here is that one should gradually do it after understanding all the pros and cons, because today what is happening is there is a lot of excitement. Sometimes somebody says China is great, sometimes somebody says Vietnam is great. There's a lot of excitement, and the allocations are very reactive. Now, if you ask me, simply put, I think US as a market is a great diversifier for Indians, right? Because traditionally you've seen that correlation between US equities and Indian equities is slightly on the lower side, right? So it definitely adds value, and it also helps when rupee depreciates against the dollar, right? So the cycles are tough. Whereas emerging markets, normally, I mean, India is categorized within the emerging market bucket. So emerging markets move together. So you may not get the correlation benefits if you allocate your funds in emerging markets, but US is a great diversifier. So I definitely feel that starting point should be US. Now, US, it could be an index fund, and I'm just putting it out there in the open, because a lot of people I meet, they say that let me just buy Apple, let me just buy Google, right? If investing were so simple, I mean, you know more than us. I mean, you've been investing monies, but if investing is not that simple, right? So the first step is to maybe buy the index of a good market like US, make it maybe 5 or 10% of the portfolio, and gradually I think 20-25% is a good number. The second space, Karthik, which is becoming very interesting, and we chatted about this a little while earlier, is the entire global bond space, right? Today, think about it, right? The 10-year yield in India is at 7%. Global bond yields, right? Good quality bonds are closer to 7%. So you can build a 7% dollar portfolio. So it's very difficult we have a home country bias, but for a dollar investor, it's very difficult to justify that they are investing in an emerging market, which is traditionally where the currency is traditionally depreciated, versus holding a bond portfolio, which is giving you the same yield in dollar. Here you're getting a rupee yield, right? So global bonds are becoming very interesting for HNIs. As far as the currency is concerned, I mean, see, the longer term depreciation rate for Indian rupee has been 4%, right? But what happens is that it depreciates in short windows. You have a long period where rupee doesn't do anything. And I don't know, what is the average vintage of the audience. But, when I tell people that there was a period where rupee actually didn't depreciate for 8 or 9 years, people get a little shocked. But we've seen that period, right? I think 2002 to 2010. Rupee actually didn't depreciate, or probably appreciated, right? And then, of course, you had a very short period within which it caught up, right? So if you look at the longer time frame, 4% is the rupee depreciation, right? There are certain decades where it's done 5%, certain decades 2%, certain decades maybe 3%. My view is like this, and these are things which are very difficult to predict. But I wouldn't be surprised, Karthik, that if rupee doesn't depreciate at the same rate that it has depreciated in the past, like past if it's 4%, maybe the par for the course is 2.5%, because our current account is looking much better today. I mean, if you take the services exports, if you take the IT exports, if you look at our balance sheet, the total reserves, I mean, the fact that now today India has come into the global bond index, JP Morgan has announced, I think we are in for good times for the currency. And, if you ask me my gut, and, this is something that I don't want to, I typically don't say it, but, I won't be surprised if rupee actually doesn't depreciate, given the way things are moving for us. So, but having said that, that should not be the sole reason for you to diversify globally. You must have some assets globally it gives you correlation benefits on the portfolio.
Perfect. That's a very nuanced answer, and it's a combination of tactical as well as, how do you sort of build a rounded out portfolio, including very valuable thoughts on how to build out a dollar exposure gradually, using indices and so on. You also beat me to the point of the JP Morgan emerging market index classification. Very interesting to note that, global bonds, are yielding significantly higher returns, which is something that investors in India can absolutely think of, whether it's through the LRS or a quick question before Vikaas jumps in on your thoughts on the GIFT. You mentioned feeders, but a GIFT as a vehicle to build out an offshore. Just quick thoughts on that before Vikaas jumps in.
Yeah, so it's a very interesting jurisdiction, and I think we should have done it earlier, because most countries have these kind of jurisdictions within. I mean, everybody has an offshore kind of a place. See, there's a lot of activity which has happened around GIFT, and I know that for funds which are investing in India, there are already structures which have been set up, and incrementally all the alternative funds are looking at having GIFT city structures as opposed to maybe somewhere in Mauritius, right? So there's a lot of work underway. There's one clarification expected, which I think should flow through, which is what percentage of that fund can be held by NRIs. Now, if that is freed up, right, I think today the restriction is something like 49% and 51% you need to have for FPIs, right? If that gets freed up, I can tell you a lot of money will flow through GIFT into India as opposed to places like Mauritius or maybe some other geography. Now, as far as money going outside from GIFT, that is where the ambiguity comes in. Right now, if you see the regulations, it's reasonably I would say flexible. Today, through GIFT, you can take almost 50%. You can take 50% of your net worth as per the OPI guidelines, right? Now that can be a fairly large number for a lot of companies. So I think there is also a little bit of, if I may say, confusion when it comes to the regulator or the central bank, because you're basically saying that rupee is almost convertible. Right. So there are a lot of discussion papers. There are a lot of discussions happening. We know a couple of the large family offices have put in their applications for a structure that there. So there is a little bit of ambiguity on that front, taking money outside. But I'm sure it will evolve. It will evolve, and it will become a fairly attractive, if I may say, destination. Already your SGX Nifty has become GIFT Nifty. So GIG 50, right? Correct. Gifty. So Gifty. So I'm very, very positive, and I think all of us, in the financial services space, asset managers, wealth managers, are looking to set up structures. See, the money coming in is very clear. I'm sure most of the asset managers will look to have structures there for attracting money from outside. Is the money that goes out of India is where there is a little bit of ambiguity. But even now, for depending on the size of your portfolio, right, you can create a VCC structure outside where you can have a bond portfolio. I mean, whatever tax opinion we have taken, it is tax-wise also pretty attractive. It's treated like unlisted equity, so you get indexation benefits and long-term capital gains benefit. So a lot of wealth managers I know are looking at that opportunity as well.
Thank you. Appreciate that. Vikaas?
Yeah, in fact, Ashish, on this NRI part, straws in the wind are revealing that regulation would come in very soon. The entire NRI thing get freed up. I think it is going to happen very soon. Yeah. And I think that is something which is going to fulfill a long-standing demand from the industry, and that is going to be a big catalyst. I completely agree with you.
Absolutely.
So talking about opportunities and moving beyond conventional debt and equity, one of the things I wanted to ask you is, from your vantage point, what are the other opportunities you see there? In terms of alpha generation for the typical ultra HNI or family office investor. What are the other opportunities you see?
Right. So, look, I'll just spend, maybe a couple of minutes on the traditional opportunities so that, I can then extrapolate the opportunity that is beyond that.
Sure.
We had a tax change recently on debt funds, right? Now, that has clearly made debt funds far less attractive than what they used to be earlier. Okay. However, I still believe debt mutual funds have a place in the portfolio because they'll just have to be positioned more innovatively, right? I mean, as opposed to bank deposit, where you have no choice but to pay tax on accrual, and interest gets paid out or it gets accumulated, you still have to pay tax. So there's no compounding benefit, right? As opposed to that, a debt fund still compounds your money. I mean, it may be fully taxable, But let's say you keep your money for 10 years in a debt fund. I mean, 10 years is compounding, right? So
Correct.
whenever you withdraw, you take your money out. So it's still a very powerful tool to create a fixed income portfolio. However, now that the tax situation has got neutralized, I mean, in the sense that whether you directly go and buy a bond or you go through a
It's
debt
the same
mutual
thing.
fund, taxation is same. Earlier, you had a significant benefit going through a mutual fund because of
Correct.
the long-term capital gains benefit. Now, a lot of HNIs or ultra HNIs, right, who have the wherewithal, or rather who have the size of the portfolio and the wherewithal to take some additional risk in the portfolio, are looking towards other opportunities like credit, other opportunities like structured debt, opportunities like global bonds, to create alpha in their portfolios. I mean, simply put, today there are structured credit funds where you can structure a deal with a corporate with very strong cash flows, but maybe a temporary challenge on the balance sheet, and the yields can be anywhere between, I mean, if it's what is typically labeled as a performing credit, right? When I say performing credit, I think these are corporates where there is no distress, but they are relying on private credit for certain sources of capital, and you are able to get 12 to 14%, right? Similarly, you can do structured credit transactions anywhere between 16 to 18%. Then within the same bucket, you have real estate funds. So real estate is nothing but structured credit, but the underlying cash flows come from, let's say, a real estate project, or the underlying collateral is a real estate project itself. So there is a lot of activity around this, and globally, this is a very large space, Vikaas. So it's just a matter of time as more capital creation happens in our country, as more and more people get capital to allocate and become more structured in the way they create their portfolios. This category will only grow. I mean, I was just trying to get a handle of the number, and I think if I take the structured credit space, real estate space, organized Cat 2, possibly, I mean, maybe it will be closer to today, 30,000-40,000 crores. But I wouldn't be surprised that this becomes 10x in the next 3 to 5 years. So big opportunity for obviously investors, but equally big opportunity for asset managers and wealth managers to create these kind of solutions for clients. Similarly, global bonds, I mean, we just spoke very briefly, Karthik and I, that you can create structures, outside, and once the clarity comes on GIFT City, you can create it in GIFT City itself. Whereby you can get a global bond portfolio, right, at rupee yields. I mean, in the sense that if rupee yield today you can achieve a 7-8% in good quality bonds, you can get the same yield in dollar today, right? And if the rupee does depreciate, then your total return in rupees can be much higher with a decent taxation outcome, right? Whatever I am hearing, whatever opinion we've got, I mean, you can get indexation and long-term capital gains, provided it's a structure which complies with the taxation guidelines. So a lot of interesting things happening, Vikaas, and I think as a country, as we become bigger and GDP increases, the capital formation becomes more innovative. These kind of opportunities will only keep expanding. And then of course in the listed space there is REIT also, which is a quasi which is a go between let's say a little bit of an equity upside and cash flows that are reasonably predictable. And within that, now you had retail REITs, right? So a lot of innovation will happen, because it's just the sheer amount of savings capital flowing into financial assets will create the necessity for it.
Interesting. I recently, was making a presentation, and I got some data. I'll send you that presentation. It was a very interesting point. You talked about demand for private credit. We run some very successful private credit strategies at our end, but turns out that as the demand for capital is going up, particularly from the point of view of unlisted companies or unicorns, or sunicorns and unicorns, 30% of their requirements will be met through private credit in the next 3 years. That's a massive jump, which is expected.
Yeah, and I forgot to mention, venture debt is another category which is growing.
I'm talking specifically that.
Within the same, yeah, absolutely.
Absolutely. So it's a very interesting presentation. I'll just send that to you. But talking about strategies, talking about opportunities, and I'm coming back to your alpha strategist in particular. You have a very well respected framework in terms of 4C, which I've seen there, right? But I just wanted to understand from you in layman terms, if people out there who are looking at your research, they would want to understand that how does a particular fund house make the cut in terms of coming onto your recommendations? You must be evaluating thousands and thousands and thousands of opportunities coming your way. So what are the basic tenets you use to evaluate and recommend some fund strategies to your clients?
Right. So, as you know, I mean, the framework is called 4C, and it was originally influenced by the writings of Michael Mauboussin. And first, we kind of applied it to equity strategies, and then we kind of extended it to fixed income and now alternates. Essentially, there is a fundamental premise, and I think true for all asset classes. Equity, it's even more true. That is, looking at near-term performance actually can lead you to very bad outcomes. I mean, we have a data slide which is presented by most people in the industry, whereby if you take the last 3 year, if you rank equity funds on last 3 year performance, right, and then you take their performance in the subsequent 3 years, that is the next 3 years, invariably the top performing mutual funds fall to the third or fourth quartile. Right. So by default, if you select funds which have been top performing last 3-5 years, it can lead to very bad outcomes. That is point number one. So then we said, how do you select this? And obviously we had some help, from Michael Maubousin's book. And essentially we arrived at the 4 C's. The first C is essentially clarity of philosophy, because what he says, and Michael Mauboussin has studied fund managers and markets for many years in the US, right, which is a very evolved and developed market. He says that ultimately a fund manager who can stick to his philosophy and apply that philosophy effectively will win in the long run, in the sense create alpha or create consistent performance. So one is first is trying to understand the philosophy of the fund manager, right? Whether the style is more value oriented, growth oriented, or GARP, and you have multiple styles. But at the end of the day, everything is married at the hip, whereby you're trying to understand whether a company will create more cash flows than what the valuation the market is giving today.
Absolutely.
Right? So then understanding the philosophy and whether the fund managers applied that philosophy consistently in the way they manage the portfolio is clearly one big influencer in whether we onboard the fund manager or no. The second is, and similarly in debt, we would look at let's say if the fund manager is a duration fund manager, let's say they're buying, it's a government securities fund, right? Government securities fund, you're not taking credit risk. The one way you can create alpha is by managing the yield curve. And for that, you need to have a reasonable idea of the macros, predict interest rates. So there we did something very interesting, because on the fixed income front, we saw around the monetary policies, right? What was the messaging of every fund manager? And we saw pre-policy, post-policy, and how many calls the fund managers got right, and how the positioning of the yield curve was in that portfolio. So we did some very interesting stuff in fixed income, although we talk a lot about equities, but we did some very interesting stuff and we got some amazing results. Similarly, if it's credit, then what is the philosophy of picking up credit and stuff like that. So philosophy is very, very important at the core and heart of how long and how what kind of work we want to do with the fund manager. Second is consistency of performance, self-explanatory. Within equities, we look at rolling returns as opposed to point-to-point returns. We look at number of times the fund manager has created alpha as opposed to the absolute alpha that the fund manager has created, right? Because what we figured was the more consistent the fund manager is, right, the higher the chances of the investors to stay invested.
Okay.
The challenge with outsized alpha is that you'll also have outsized negative alpha during certain times. Now what happens is, during those times, the ability of the investor to stay invested is very, very low. So then even if after that, if you create an alpha, it doesn't matter because the investor is out. Right? But if you're more consistent, right, you also are able to keep the investor throughout the journey, right? So consistency of performance, consistency of philosophy, that's the second C. Third is capabilities, right? We look at the team framework, how many people are involved, what is the background of the team, and how does the team interact with each other. And fourth C is we call it the class, which is again like I say, form is temperament, class is permanent. What is the cycle that the fund manager has seen, right? In equity, has the fund manager seen at least two bear markets, right? Because like Howard Marks says, there are no old bold investors. So, you want to see how the fund manager reacts in a crisis, right? Similarly, in interest rates, you have cycles, right? Credit also, you have cycles. How has the fund manager seen cycles? What have they done during those cycles? So it's a very robust framework. And obviously, not all C's will be checkmarked by everybody, but, broadly, this is how we approach selecting fund managers. And then, of course, you adapt, right? You're also constantly learning. The best part about our industry, Vikaas, is that we are applying and learning at the same time.
Absolutely. I agree with you. In fact, even while you were speaking, I was making notes. Some of the things are very, very interesting to me as well. There are no old, bold fund managers. I heard this a long, long time ago. It's just so profound and true, isn't it? Absolutely right. Yeah. Karthik, over to you.
Yeah, no, I think Ashish touched upon most things that I was very curious about. Perhaps the only thing, quick thoughts, is we often talk about fundamental strategies like credit and equities, and within credit, what is the theme of maybe the last 5 years or currently. Quickly touching upon your thoughts on what you think about, everybody, when they think of India, they think of gold. So the commodities is something, that's a big part of, let's say, a hedge fund strategy, which is, multi-billion dollars worldwide. So do you have any views on how one can, maybe institutionalize, and are you seeing some trend towards commodity investing in India, or, do you think the risk reward currently is, not very favorable, or, whatnot? I'd love some quick thoughts from you before we move on to a Q&A.
Yeah, so very interesting. Let me talk about gold first, right? Because gold is a very different asset class compared to the other commodities. So gold, we've always advocated that intrinsically every portfolio should have some allocation to gold. I mean, Indian households already have a large allocation to gold. So obviously you have to see first in your overall net worth, how much gold do you have and how much gold you want to add in your financial portfolio as well. But definitely gold warrants a place. And the reason for that is very simple. And I have a very different way of looking at it. Let's say you are predominantly an aggressive investor and you're mostly equities. I feel you should have a reasonable allocation to gold. If you're a largely equity investor, then you could even have 15-20% allocation to gold, because gold is, in a sense, the antithesis of equity, right? It's a crisis asset class, and it's an asset class which gives you the firepower during crisis, right? And we often say that, hey, you need to rebalance your allocation regularly. And when equity markets are down, or if there is a crisis, you should add to equities. So where do you add to equities from? That during those times, gold becomes very, very important, right? Typically, we've seen gold is negatively correlated to equity. So on a lighter note, I tell people you have some gold in the portfolio, but pray it doesn't perform, right? Because if gold doesn't perform, everything else is performing, right? But if you do end up in a crisis, then, you can always take out some money from gold and reallocate. So that's where, I would say gold, comes in. Very important asset class, to be honest, in our overall framework. As far as the other asset classes come, and I think we chatted about this, that within that you have global commodities and you have domestic commodities, right? Domestic commodities typically are more perishable in nature. Agri commodities, there's a lot of chatter around this. To be honest, in India, it's still not a very evolved asset class, right? The challenge is being around regulation and intervention. Because these are essential commodities, and we've seen often in the past that when essential commodity prices tend to go up, speculators have taken positions, and the government suddenly comes and bans the trading, or let's say the government comes and regulates the price or tinkers with the price. Then what happens is that it leads to losses, and you're not able to take a view on it, right? So I think it's still a very nascent asset class, and not necessarily for most investors. Yes, there are very sophisticated investors who understand this asset class, can probably take a view and do something around it. But I think global asset classes are like equity, right? Again, I do believe it's for sophisticated investors, large family offices, because let's take for an example silver or a copper, right? Silver still is a quasi-precious, quasi-industrial metal. Copper is completely an industrial metal, or aluminum is clearly an industrial, right? Now, there you have to take a global view, you have to take a view on demand, supply, the cycle, right? So it's a very sophisticated asset class, and we've not seen too many funds take that view. Probably in a lot of these cases, you can take the view from an equity lens. Let's say, for example, if agri commodity is doing well, generally you know that rural demand will be good. So anything rural facing should do reasonably well. So even if you're in a strong agri cycle, then stocks which are rural facing will do well. Similarly, if you're in a global metal cycle, positive cycle, then, again, firms which are strong in those sectors will do well. So maybe it's a better idea to take view through the lens of companies or stocks. But gold clearly is a great asset class to have in the portfolio to counterbalance the risk that you're taking. I mean, simple equation is if you have more equities, you should have more gold. If you have less equities, you should have less gold. So it's a counter asset class to growth and to hope and optimism.
Very logically articulated. Thank you for that, Vikaas. Back to you.
I think we are getting flooded with audience questions. So I'd straight away go to them. In fact, you already answered Vicky Talreja's question. He's asking, hi Ashish, as you mentioned, for diversification through US-based index fund in the same way, gold would be good for diversification too. I think you've already answered that. But he's asking if yes, what percentage of gold does a decent portfolio should have? What percentage of gold? I mean, you talked about equity and gold being antithesis. But if it's a diversified portfolio, normally what proportion of gold would you recommend?
Generally, we've done a lot of work around this, Vikaas, and we've done back testing. 10 to 20% gold is a good allocation.
Perfect. So Vicky, 10 to 20% is a very good allocation.
The whole thing works very well when you keep rebalancing it. Right? Every year. A yearly rebalance is the best period. A lot of people ask me what is the best frequency, and now don't ask me why it works. But we've just done back testing for 30 years and we found that yearly rebalance works beautifully. So for all wealth managers out there, if client asks you, how often will you rebalance my portfolio? I mean, if you just do it yearly, you will have a reasonably good outcome.
Beautiful. That's very clear. Giridhar is asking a question. Generally, what would be the percentage of investments into large, mid and small caps to have a 15-16% return on capital?
See, returns will vary. I mean, right now we are all wired to, the last 30-40 years, we've kept repeating this 15% number. Now, though that could change, as your markets get more evolved, and maybe 12. I think a more nuanced way, because I believe that a lot of your audience is a little more evolved because a lot of wealth managers tend to log in. I think the more nuanced way to look at it is what is the inflation plus number, right? So inflation plus, I mean, typically if inflation is at 6, I mean, we are used to 8 or 9. Now inflation is gradually coming off. So 5-6 agar inflation hai, so you add 600 basis points on it. So 12% plus is a good number for equities. Yes. Within that, you obviously have a higher expectation from mid caps, higher expectation from small caps, but just take a cue from the market. If you take the market index, let's say the 500 of India, S&P 500 of India, that is about, I think, 75% large cap and 25% mid and small cap. Now, as a country, we are all very bullish. So possibly, 55-60% large cap and a 35-40% mid and small cap is a good combination. But there again, can I add a little more there, because little more nuance,
absolutely,
right? Because you have a lot of wealth management kind of people logging in or investment kind of people logging in. See, I always keep saying mid and small cap. Maybe there are two kinds of mid and small caps, right? One is to just make it very simple, right? There is a hope stock, and I'll give you an example, right? Let's say in a sector there is a leader, right? And the leader is a large cap by definition, right? Because they are large, profit outcomes are also large, right? Then there is a fourth or fifth player, right? Who's small. Now that player could be mid or small cap, right? Now there is often you have the hope that this is the next so-and-so organization. This is the next so-and-so multi-bagger, right? And these are all hopes. Now 90% of the time hopes don't turn out, right? So that's a very bad way of creating a mid and small cap portfolio. But the other way of having a mid and small cap portfolio is you choose a category or an industry which is still small, nascent, but has a large growth potential. Now, wo industry mein, if you take the leader also will be a mid cap, right? But that's a very strong portfolio. You're buying a category leader in a category which is small, which is expected to grow very strong. So there the risk profile is like large caps. I'm just going a little more nuanced. I mean, broadly, yes, TK 60-65% large cap.
Yeah.
So
you have the category itself growing exponentially, and all the stocks in that category also growing exponentially. Interesting. So if I can just dare ask you a question, do you think fintech is one of those sectors? Just to understand that a little.
No, I think so, because see, digital journey for India has just started, right? And the underlying infrastructure is world class, right? In certain things, we are better than the globe when it comes to especially payments and the speed and the UI UX. So I would definitely think fintech is in that category. Now, who will win is the game, or is the puzzle to solve for fund managers, or if there are individual investors who have the time to do research and all, you have to solve for that. But definitely, you will have very, very big companies coming from the digital space over the next 10 years.
It's interesting. One question which Ajay is asking is, how do you see investor preference for multi-asset funds coming up on the AIF platform?
So, logically speaking, because there should be a lot of interest, but the challenge is taxation. See, mutual fund is the simplest vehicle, right? So, I mean, within a multi-asset category, even if you keep rebalancing, it's not very the taxation is very, very advantageous, right? It's only when you take out money, you pay the tax. Whereas AIF mein kya hota hai ki, first of all, the rules of the game are loaded against AIFs, because you can't buy mutual funds in AIF, first of all. So that category itself is out. So you have to go and buy other AIFs, or you have to buy direct underlying instruments to create a multi-asset kind of portfolio. So taxation is a big drag, but I'm sure it will evolve. Like, I am very positive on a multi-asset AIF for alternative categories. So let's say, for example, today, and we spoke about it, you have structured credit funds, you have CAT2 mein, you have private equity funds, then you have the venture capital space, right? Now, can you create a fund which combines 4 or 5 of these categories, but gives a return profile which is a little more consistent and stable? I'm sure you'll get correlation benefits. Let's say you put a private credit fund with, let's say, a venture capital fund, and you put a private equity fund. See, you can in AIF can invest in AIFs.
Yes.
Okay, so you can actually create a multi-asset AIF through that for growth categories.
Fabulous. Incidentally, one of these questions is going to be the beneficiary of a prize. So, I will eventually ask you to choose one. But these are very interesting questions. We have a few more minutes. I will take a question which has come in from Yashin. What is your view on Indian markets with global economies in crisis? China is at its worst stage. Europe and US also at the brink of recession. Do you see FI outflow during the next 2 years?
Yeah,
bit of a counterintuitive question, but yes.
I know. Yeah, so in fact, whatever he has mentioned in his question is actually an advantage for India.
Absolutely, that's correct.
So okay, so let me make it a little more nuanced. If globe doesn't do that well, will it shave off some growth from India? It will definitely shave off some growth, right? We are integrated into the globe. But what happens is, at 6%, 7% growth, you are an oasis in the desert, literally, right? We are the fastest growing large economy in the world today, right? So if anybody wants growth, they, one of the clear choices for them is India, right? And just to think about it this way, that total world GDP will be $100 trillion. No, yeah, I mean, little over $100 trillion. I think I'm right there, right? But you look at global market cap, because not too many countries in the world. See, there are a lot of GDP contributors, but there are not too many developed capital markets, right? So India will be 3% contribution in the global market capitalization. So given the depth of India and given the size of opportunities, I think India can be much larger. So I would say the contrary, that actually a lot of these things actually are an advantage for India. Outflows from time to time will happen, but we have always been a net receiver of capital. We have always been a net receiver of capital. Yeah,
I would tend to agree. Umesh Singla is asking a very direct question. Can you recommend any dollar-denominated bond portfolio offered by any AMC where Indian investors can invest? A dollar-denominated bond portfolio where Indian investors can invest.
There are few which have been launched. I mean, I think we have also done it with one of the providers outside. But then one of the AMCs locally has launched a US GSEC fund feeder, and there are a few others. So there are a lot of choices. So I think, if maybe you can individually sit down with the investor and take them through the choices.
Will it be part of your alpha strategist? Can you look at the alpha strategist and find out?
Yeah, absolutely. It'll be part.
So
I mean, if I can name the provider, I'll name it.
Please,
well, we have tied up with Silverdale in Singapore to offer a dollar bond portfolio for our clients. That is seeing very, very good traction, and the yield is almost close to 9%. Of course, that is leveraged one time, but you get unlevered portfolios as well.
Very nice. I'm just okay. What are the options available to invest in US and German bonds from India? Any specific feeder funds that are available? Somebody's talking about German bonds.
German bonds.
If you have some idea on that.
German bonds, no idea. I mean, not looked at German bonds, to be honest.
So this is something new to me as well. I'm surprised somebody's looking at Germany in the first place. Sorry, this is on a lighter vein. Okay. Namit Aurora is asking a question. I think it's a very oft asked question, and maybe you can just paraphrase it. What are your thoughts on the active versus passive debate and your perspective on quant investing?
Yeah, so I think this is a very heated topic.
Maybe you could talk about quant. I think active versus passive, it's very divisive, the entire discussion. Maybe
but I just want to make one statement that, it doesn't have to be active versus passive. It can be both.
Agreed.
Right? You can have part of the portfolio in passive and some part in active. And again, it's very personal philosophy. I'm all active, by the way, personally. I do believe active managers have a large role to play. As far as quant funds are concerned, I think very interesting space. It'll evolve. And it'll become a category. I'm positive on it, because again, just think about it as a core philosophy. You're basically trying to remove human intervention, right? And with today, the kind of computing power you have, the kind of algorithms you have, I won't be surprised in the near future if a computer becomes a fund manager. I mean, already in US, you're seeing that, right? Because ultimately what it's data integration, right? And decision making. Now, computing
I know for a fact that show hosts have become computer generated. So my job is obviously already out there. That is on a lighter note. Last question, which Vaishali is asking. Again, this is something which you may like to answer. Real estate seems to be at an all-time high in top-tier cities. Do you anticipate further growth in this sector for the next 3 to 5 years, or is this sector reaching saturation?
So I'm not too sure when she's saying real estate is an all-time high. Is she saying business-wise, volume-wise, or price-wise? Because see, volume-wise, it is an all-time.
It should be price-wise, because she's talking about top 3-tier centers. So obviously, she's looking at top-tier centers, and she's talking about price-wise. It looks like it.
Okay. So look, these are my views on real estate. One is volume-wise, yes, real estate is at an all-time high, and we've seen volumes recovering, but nowhere close to potential. And I'll give you this number, which a lot of people get surprised when I give this number, is the total sales of real estate in India by value, new sales. I'm not talking about houses, second-hand houses which are sold, right? And the total sales of vehicles in India are the same.
Oh, really?
4 lakh crore or 4 lakh crore, roughly. I mean, thoda upar niche hoga. So, but the need for housing, right? The demand for housing potentially is much larger. So we believe in the next 5 to 7 years, this can become a minimum 11-12 lakh crore kind of an industry, right? Per annum. Now coming to prices, I think this time around, the cycle has been pretty good in the sense that, look, you clearly had a 8 to 9 year period, I think, where real estate prices remained stagnant. Right. So what has happened in the last 1.5 to 2 years is a bit of a catch up, right? Depending on which city you're in, maybe prices have gone up 20-25%, some places 30%, some places 40%. But I'm saying still, if you look at affordability, right? There's an affordability index which is published. It is still very low, very high. Affordability is very high. So which means the values relative to inflation, or if you take a slightly longer time period, values of real estate is still okay. So I keep telling this, that if you want to buy a house for consumption, which is your own use, there couldn't be a better time to buy it, because best of regulation, the quality of housing has gone up, the kind of amenities which you get, mortgage rates are still okay, they're not that that crazy. Affordability has gone up because 8-9 years real estate went nowhere in terms of prices, and abhi 1-2 saal mein you've seen it go up a little bit. So I
Well,
don't.
it's an interesting thing which you
Yeah.
mentioned, Ashish, because we've run several real estate debt funds. I mean, just to give Vaishali the other side of the prism, it's a highly micro market strategy. So to generalize saying top 2-3 tiers, I mean, we've been running it. We've not seen a single rupee of default or delay simply because we've been focusing on micro markets in the south. So I think it's a very valid discussion point which you mentioned, Vaishali. But the only thing is, like what happens in most cases, we tend to paint everything with one brush. Equity markets are too high, debt is like this, real estate prices are too high. There are several layers to it, and I think Ashish was talking just about that. A lot more questions coming in. I will just take one question, and then we'll decide on the best question because we're running out of time. What is your long-term take on large cap IT companies? Since the strength of a currency due to bonds inflow will take the margins away.
Yeah. So, I mean, again, this is a view, and views can be right or wrong. I see there is so I'll tell you the framework, right? How I look at these things, right? So there are sunrise sectors, right? And then there are middle noon sectors, for lack of a better word, and then there are sunset sectors, right? So I would say, large cap IT is somewhere in the noon, and I mean, not sunset is a bad word, but very evolved kind of businesses, right? Where growth rates slow down, but stability and visibility of cash flows is very high. I mean, even today, ROE, ROCs are extremely high. So I would say that IT companies can be the stabilizer in a portfolio, large IT companies, right? But to expect that they will, give you some crazy outcomes, I think that definitely is not the case. You'll have to look elsewhere. So I think as part of a large cap portfolio where you need stability of cash flows, where you need a stable outcome, because see, this arbitrage between Indian IT and global IT is not just rupee led. I mean, there is genuine price arbitrage, massive. I mean, I was just talking to somebody, and very interesting conversation. He was saying, I mean, this guy works for a global MNC out of New York, right? So he was telling me that his global IT head, they are pushing people to come to office. Okay. Now, most people are resisting in the US, as you know. So he basically said that, look, if you're not coming to office, how does it matter whether the guy is in New Jersey or he's sitting in Hyderabad? Absolutely. If I have anyway talk to them on Zoom. But he said the difference is that what the guy in New Jersey does for $125,000, the person in Hyderabad will do for $20,000 and so give you 40-50% more output. Right? Absolutely. So I see this accelerating actually. The service onshoring in India. And it's not just IT now. Even the back office of some of these large firms, right? Whether it's PwC, Deloitte, some of the investment banks. I mean, offshore, there is, offshoring to India is happening at a fairly fast clip. So I don't see that, slowing down. Of course, the kind of work that these people take will keep changing.
Fabulous. If it's okay with you, Ashish, I think there are two questions we could give prize to joint winners. One is Vaishali, who asked this question on real estate. She just sparked off a very tangential sort of a conversation, which I quite like. And the other one, which Ajay had asked in terms of multi-asset allocation platforms. So if it's okay with you, we can probably give a prize to both of them.
It's quite amazing. I had actually picked out that one, the multi-asset. I thought that was a great question. And yes, this one kind of took us on a different thought process.
I must tell my viewers that when I started this show in my previous avatar, Ashish was the first guest. And I still remember I was told that we have to close the show in 1 hour. It actually went on for 1 hour, 20 minutes. I was mindful of the fact and I said, this time I'm going to close within 1 hour. We're already at 1 hour, 5 minutes. So Ashish, I think time just flies when people are in conversation with you. I'm getting so many compliments coming on the question box about your perspectives. Thank you so much for being here, for answering some questions very candidly. It's been a real pleasure talking to you. Thank you, Karthik, for your questions. Thank you, team PMS Bazaar. I think it's been a fabulous insight. And Love talking to you once again. Thank you so much.
Thanks, Vikaas. It's been my pleasure to talk to you and Karthik and the PMS Bazaar team, and also would like to thank all the people who've tuned in and giving their time to hear us out, because we can go on and on about this subject, right? This is absolutely passion for us. So great. Thank you very much, Vikaas. I think I really love this conversation.
Likewise.
Thank you, Ashish.
It was a very informative discussion, and I hope all the participants, the listeners, had many takeaways here. So thank you all for your participation. See you all in another interesting session. Once again, thank you.